Ever seen a central bank inject $120 billion a month into the economy? Here's what that looks like. This is the U.S. Federal Reserve. It prints dollars, sets interest rates, and acts as the global lender of last resort. 60% of the world's foreign reserves are held in U.S. dollars, and global trade depends on it. So when the Fed raises rates or prints money, it doesn't just affect the U.S., it affects your EMI, your fuel prices, and your stock market. If QE was money printing, then QT is the global vacuum cleaner, and markets hate it. Quantitative tightening, or QT, is when central banks reduce the money supply by selling bonds or letting them expire. This pulls money out of banks, raises interest rates, and tightens credit. All without moving policy rates directly. QT started in 2018, but markets crashed. It returned in 2022, and trillions began disappearing from the global economy. When the Fed sneezes, emerging markets catch a cold. Here's why. The U.S. Federal Reserve's decisions ripple globally, influencing capital flows and currency values. Higher U.S. interest rates attract investors, pulling money out of emerging economies. This exodus can devalue local currencies, making imports costlier and fueling inflation. Countries like India feel the pinch with increased borrowing costs and economic slowdowns. The world doesn't just sit back when the Fed acts. Here's how nations fight back. When the Fed tightens policy, countries like India, Brazil, and Indonesia often hike their own interest rates to protect their currencies. Others build up forex reserves or sign currency swap deals to defend against dollar outflows. Some are now shifting to rupee, yuan, or gold-based trade to avoid overdependence on the US dollar. 60% of the world's forex reserves are in dollars, but now, that grip is weakening. Countries are turning to gold, yuan, and bilateral trade deals to bypass the dollar. China is settling oil in yuan. BRICS is building an alternative system. Even India is trading in rupees with 18-plus countries. But replacing the dollar isn't easy. It still powers 88% of global forex transactions. What happens if the dollar stops being king? The shock won't just hit America, it'll hit you. The US dollar backs 60% of all central bank reserves and powers 88% of trade transactions. If countries dump dollars, the US faces higher interest rates, inflation, and a collapse in global trust. Emerging markets may gain short-term flexibility, but lose out if dollar volatility crashes exports or reserves. BRICS, gold, crypto, yuan. Everyone's trying to replace the dollar. But here's what the data says. Even in 2023, 88% of global trade is still settled in US dollars. The Chinese yuan, used in just 5% of SWIFT transactions. Gold-backed currencies, hard to scale. Crypto, too volatile for now. So while the dollar's dominance may fade, there's no clear successor yet. The world runs on trust, and the dollar still has the most.